Hey, what's up? Jason here again. And today I'm going to talk to you about two things. I'm going to talk to you about the idea of Mr. Market from Benjamin Graham. And I'm also going to talk to you about the second company that I bought, which is AIG. All right. And right now I'm just posting videos because the blog is still being set up. It should be up in a few days. And also, don't worry, right now I'm just covering stocks that I bought in the past, but after I cover this one, the next ones will all be stocks that I've never looked at before and that are, I'll be looking at them now, how they're doing now rather than in the past. So, the book The Intelligent Investor by Benjamin Graham, this is a book written by the person who taught Warren Buffett most of his investment philosophy. And in his book, he has a chapter that's called Mr. Market. And what this chapter is about is one of the most important keys to being a successful investor. And what he talks about in this chapter is the idea of Mr. Market. Okay, so I'm not going to explain exactly how he explains it because I don't remember exactly how he explains it, but I'm going to try and explain it the best I can so you can understand. So imagine that you have a business partner. Okay, you're in a business, and let's say you own a farm. And you know that every year the farm gives you a certain amount of money, and it's pretty consistent. So and chances are nothing new is going to happen to the farm. And the problem is though, and you want to buy out your business partner, okay? But the problem is that your business partner is a little crazy, okay? And by this I mean he's a very one day he'll be super optimistic, and the other day he'll be super sad. And because of that, it reflects the prices he'll offer you for the business. So one day he wakes up and he offers you $1 million, okay? And the next day he wakes up and he offers you $10. Now what you see here, what's important is that his offers have nothing to do with the value of the business necessarily. All they have to do with are with how he's feeling, how he feels that day. And his offers don't actually change the intrinsic value of the business. If you know this farm is going to give you $100,000 every year, then it doesn't matter what he offers you because you know it's going to earn you that. All that matters is that you buy it at a lower price, or at a price that's worth it for you, that you couldn't get a better earning from putting the money somewhere else. Okay? And this is actually kind of the way that stocks work. You know, if you find certain types of businesses, they have very stable earnings, and because people don't really understand stocks, or because people speculate, or because of all types of reasons, stocks will be mispriced. So one day the market will come to you and say, hey, there's a stock that consistently earns $10 per share, and today I'll sell it to you for $1. And the next day it'll come and say, I'll sell it to you for $1 million. And it doesn't change the underlying value of the stock, what the price is, right? It's the same thing if you owned a home. If you owned a home and one day someone came up and said, hey, I'll give you $1 for your house, would you start freaking out? Oh my God, my house is $1. No, you wouldn't. You just think, oh, okay, that guy's kind of weird, you know? Or let's say someone came to you the next day and offered $10 million. Maybe then you'd sell the house. But do you really want to move? I mean, it's the same when you buy and hold. You want to buy a stock when it's undervalued, and you want to hold it as long as it's giving you those earnings. And maybe one day realize the capital gain. Okay? So today I'm going to talk about AIG. All right? And AIG was a very interesting buy for me. So because I'm in finance, they spoke about it in a bunch of my classes, but also AIG was all over the news around the 2008 period when we had the financial crisis. And I was reading the Wall Street Journal one day and I stumbled upon it, and I saw some bad press about it, so I thought, hey, I'd go check it out. So I go check it out, and I noticed that if you looked at their earnings, their earning records, their earnings were actually a lot lower. But that's because of the housing crisis, right? And I also knew that they had been bailed out by the government. So when the government bails out a company, that's essentially saying that they won't let the company go bankrupt. So I know that the company isn't going to go bankrupt. And I know that AIG is in a relatively stable industry, which means their earnings should probably return to normal, right? Their earnings shouldn't stay low for forever, as if this one event, which is not reoccurring, is fixed, right? So the earnings were a bit depressed, and because of that, the stock price was severely depressed. And I knew that eventually the stock price would raise back to normal with the earnings, right? And I knew that not only would I get the increase in stock price, but I also get the increase in earnings. I haven't looked at AIG in a while, but my guess would be you should check it out, and I'm pretty sure even now it's relatively undervalued. I'm not going to say for sure or not, but I'm pretty sure it's relatively undervalued. You know, always do your own research. I mean, in the future I'll go more in depth, but right now I'm just for your own curiosity, you should check out AIG. And yeah, so that's pretty much what happened. And I looked at it, I looked more deeply, everything checked out. And I said, yeah, this looks like a good buy. Now, if you watch the previous video about Best Buy, you can kind of notice a similarity here between the two purchases. Pretty much it's a one-off event that alters the price of the stock, but not the underlying business. And its chances are that the stock's going to recover. Because of that, depresses the price, and then you get a gain. That's not what's always going to happen. But you see, what happened here was Mr. Market came to me and said, hey, I'm going to sell you this stock that earns this much for this very low price. And because I'm not looking at the market to make my decisions, I'm looking at the business. That's how I'm making my profits. And that's how most of the greatest investors make their profits. They look at the underlying earning power of the business, not necessarily what people are thinking. That can be a bonus, you know. If all of a sudden people are speculating on AIG, yeah, that'd be a bonus. But it's not the fundamental thing you're using to value the business. And what's also important is that you choose a business in a relatively stable industry, or at least an industry you can understand. If you would have bought a car company back in the 1920s, you know, when it's a brand new industry, you don't know which car is going to win. The industry is changing so rapidly, it's incredibly risky. But if you're purchasing something like Coke or like a bubblegum company, you know there's not going to be a massive revolution in that industry that's going to totally wipe out a company. I mean, it's always possible. It's a very, very low chance compared to other industries. So that's the idea of Mr. Market, and that's how I discovered AIG. And I hope that was useful, and I hope you have a great day. Till next time.